Today's highlights: are miners not selling because valuations are too low? Is Bitcoin forming a bottom, or will it test new lows? Analysts warn, will Bitcoin drop to $10,000 in 2026 and face a 90% pullback? Bittermine has taken over 70% of Ethereum's turnover. Ethereum is about to stir things up this time, using cryptocurrency to remeasure the world. Master the 24-hour wealth code, and let's gradually get rich together. Tuesday, December 30th. Where is the must-have love for the Chinese channel? I'm Mikey. Let's first look at the most important 24-hour data headlines in the crypto world. Right now, Bitcoin, to put it bluntly, looks like it's about to take off, but it's actually still buckled in with its seatbelt. The MVRV score has already dropped to 0.24, which means the price has fallen below the cost basis for most holders. The market is in an unrealized loss state, but this doesn't mean we've hit bottom. It only indicates risk release into the mid to late stage. History shows that as long as the MVRV remains in the undervalued range for an extended period, it signifies a bottom building phase, not a market turning point. More importantly, the binary CDDSMA7 has been triggered continuously in recent times, indicating that some long-term holders have started to reduce their positions in stages. This kind of behavior usually doesn't lead to an immediate rebound, but rather corresponds to a period of sideways consolidation and a redistribution of holdings. Looking back at previous cycles, whether it was in March 2024 or after the CDD signal appeared in November, the market typically needed several months to digest the changes. Prices are being pulled back and forth within a range until a new consensus is formed. Looking at the current situation, this period is more like a bottom building phase rather than a takeoff stage. Valuations have already been compressed, but confidence has yet to recover, and holdings are still being exchanged. In other words, this is neither the moment of peak panic nor the most comfortable entry point, but rather a stage that requires patience and waiting. The market is slowly recovering, but it's not ready to sprint yet. In the current market, miners are no longer selling. The Bitcoin Miners Position Index (MPI) has dropped to 0.90, which is a new low since October 2024. The meaning is simple: miners are collectively lying low. Even though Bitcoin has dropped all the way from $125,000 to $87,300, they're not in a rush to dump their coins. Instead, their attitude is basically, whatever, I'll just hold for now. Historical experience tells us that as soon as miners start holding back and stop selling into the market, it usually means the downward momentum is fading and a bottom is slowly forming. In other words, this isn't the stage where miners are dumping, they're watching and holding their breath, waiting for the next shift in the market. To be honest, Ethereum hasn't really taken off yet either. But it also doesn't look like it's going to keep crashing further. The bears are still in the game, but they're clearly not as strong as before. If you look at the data, you'll see that coins are consistently flowing out of exchanges, while staking addresses are steadily increasing. In the past 6 months, 745,000 new coins have been staked, while only 360,000 have been unlocked, which shows that quite a few people intend to just hold onto their coins. Looking at the market, that kind of panic selling we saw before has clearly subsided. The 90-day taker CVD has gradually returned from all-out selling to a more neutral range, indicating that market sentiment is cooling down rather than spiraling out of control. Although ETF inflows haven't really turned positive yet and short-term sentiment remains cautious, real on-chain usage hasn't stopped. The number of smart contracts continues to hit new highs, and the scale of RWA has already grown to about $19 billion, which shows that people are still using it. The system isn't running idle. Simply put, Ethereum right now doesn't look like it's about to collapse. It's more like it's crouching down to catch its breath. It's not ready to take off yet, but it's also no longer in freefall. This stage isn't a call to charge, nor is it an alarm. It's a transitional period where there's no need to rush. Please like and follow for a summary of the latest developments in the crypto, blockchain, and mining circles within the past 24 hours. Click the little bell and join the channel as a member to receive exclusive wealth codes from Monday to Friday. On the surface, Bitcoin seems calm and peaceful, but underneath, there's intense internal friction. The price appears stable, neither crashing nor taking off, but trading volume is shrinking. The heat is dropping and everyone is holding onto their wallets tighter than in winter. No one dares to enter the market, and old money doesn't want to move either. The market atmosphere feels like everyone is collectively holding their breath. The ETF story is still being told, but the Federal Reserve has yet to loosen its stance. With liquidity tightening, risk assets naturally start to suffocate first. As a result, Bitcoin is stuck in the middle. No one dares to chase it online, while offline, old money is holding it back. If you say it's strong, it doesn't move. If you say it's weak, it stubbornly refuses to fall. This is the classic calm before the storm. Everything looks peaceful on the surface, but there are undercurrents beneath. It's not that the market has no potential, it's that everyone is waiting to see who will blink first.
Bloomberg senior commodity strategist Mike McGlone believes that Bitcoin may have already peaked in 2025. He thinks the price could subsequently fall back to $50,000 or even possibly drop as low as $10,000. This means that, calculated from the peak, the potential pullback could be close to 90%. This assessment points to a core conclusion. This cycle will likely enter a high-level clearing phase rather than marking the start of a new upward trend.
If you look back a year ago, we were looking forward to a new president and continuous uptrends in almost every market, especially in cryptocurrencies, Bitcoin and gold. But now we're at a stage where cryptocurrencies have turned downward, the housing market has declined, the stock market is getting risky, and the crypto market, as you know, is obviously a bit shaky.
If we compare the current environment to the eve of the 2008 crisis, once liquidity truly tightens, the assets that will come under pressure first are inevitably high-risk ones, with Bitcoin bearing the brunt. Recently, Bitcoin has been consistently weakening against gold, which is seen as an important leading indicator. While a drop to $10,000 would be an extreme scenario, it is not out of the question in the context of a liquidity reversal.
The shift in McGlone's stance in recent years is itself an important signal. Previously, he regarded Bitcoin as digital gold, believing that as soon as inflation hit and the money printers started, it would automatically take off. Now, his attitude has clearly changed. When the macro environment tightens, no one can remain unscathed. He mentioned that predicting a drop to $10,000 is not about being bearish or calling for a crash, but rather a reminder that when the tide goes out, the market only recognizes reality, not faith or future prospects. When liquidity dries up, even Bitcoin has to undergo a checkup. To put it plainly, this isn't being bearish. It's about cooling things down. It's not saying that Bitcoin has no value, but reminding you not to treat long-term belief as a short-term get-out-of-jail-free card. The real question is just one. When the story can no longer be told, can Bitcoin still stand on its own? Right now, Ethereum doesn't seem lively or flashy. It's as if the market has temporarily set it aside. The price isn't fluctuating much, the sentiment is no longer noisy, the hype has died down, and attention has waned. But this doesn't mean it's stagnating. On the contrary, it's more like Ethereum is quietly adjusting its pace. Beneath the calm surface, its structure is changing, and its rhythm is being recalibrated. Compared to Bitcoin's frequent volatility, Ethereum seems to be quietly laying a new foundation and rebalancing its weight. This kind of phase is often the easiest to overlook, yet it is also the most likely to become the true starting point for the next market cycle.
Data shows Ethereum entering the staking queue has risen to about 745,000, with a 13-day waiting time. Only about 360,000 have chosen to unstake, with a 6-day waiting time. The gap between the two is widening rapidly. Up until December 27th, these two figures were still roughly equal, but now there is a clear divergence, indicating that funds are shifting from a liquid state to being locked up for the long term. Further on-chain data shows that about 5% of circulating Ethereum has changed hands, with over 70% of that being absorbed by Bitmain. Tokens are moving from short-term traders to long-term holders. This change means that the internal structure of the market is being reshaped. Tokens are gradually settling.
The case is that it's actually going to be used. Wall Street is now going to build its entire infrastructure on the blockchain, and the blockchain they're choosing is Ethereum. So this is like the 1971 moment, where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity.
From this perspective, Ethereum is entering a narrative phase, not a trough. On the surface, prices appear calm and sentiment cooled, but capital hasn't exited the market. Instead, it's quietly changing hands. Short-term speculators are leaving, while long-term capital takes over. This is typical of a structural shift. History has proven many times that real trends often do not start when emotions are at their peak, but rather take shape when the market is at its quietest and most easily overlooked. At this moment, Ethereum is preparing for its next phase of growth, not heading toward the end. More than half of the losses have been siphoned off by North Korean forces. How can the Web3 industry defend against such malicious actors? With the arrival of interest-bearing digital RMB, will the $300 billion market cap advantage of stablecoins be wiped out? This year, the crypto world has really taken a hit from hacks. According to data from Hacken, a staggering $3.95 billion was stolen in a single year, $1.1 billion more than last year. What's even worse is that the money wasn't taken by scattered individual hackers, but by entire professional teams, some of whom are familiar faces. The most outrageous part is that $2 billion was stolen just in the first quarter, and only then did things start to cool down. This shows the problem isn't just bad luck. The problem is that the foundation is flawed. It's not just bad luck for projects. Rather, the entire industry's security logic remains outdated. Simply put, hackers aren't too strong, systems are too lax. Without improved security, the next bull market will jeopardize not only retail investors, but also the entire ecosystem's credibility.
The latest security report shows that in 2025, the crypto industry lost $3.95 billion from security incidents. 54%, $2.12 billion, was due to access control and permission management errors, while smart contract vulnerabilities was only 13%, $512 million. The largest single incident was the Bybit hack, losing $1.5 billion. Over 52% of stolen funds were traced to hacker groups linked to North Korea.
About 2 hours ago, Bybit experienced a hack involving around $401 million, 1,000 Ethereum. As far as we know, this could be the largest hack in the history of our industry.
Yegor Rudistia, head of forensics at Hacking Extractor, pointed out that a large number of current Web3 projects still use the early, rough permission systems, lacking hierarchical authorization and real-time monitoring, making it difficult to contain attacks once they occur. The issue is no longer whether you will be hacked, but whether you are prepared for a breach.
The message of this report is very simple. Web3 can no longer rely on trial and error, or just patch things up as they go. In the past, hackers would break in and then we'd fix the holes. Now, you have to install security doors, cameras, and alarms from the start. Hacken puts it bluntly. From now on, it's not about who reacts the fastest, but about who has solid permission controls, monitoring, and risk management in place from the very beginning. Regulation is also tightening noticeably, especially in response to North Korea-related attacks, with requirements emerging for cross-platform joint defense and information sharing. In the short term, this means a painful adjustment. Projects will have to spend more and comply more. But in the long run, this is helping the industry drain the water, clearing out those who aren't prepared and leaving behind only those who can truly defend and endure over time. Stablecoins have been incredibly popular over the past 2 years, with $46 trillion being transferred globally in a year. They've practically become the lifeblood of the crypto world. But the problem is, this path is now being redrawn. Because with just one statement from the central bank, the digital yuan will also start accruing interest, directly rewriting the rules of the game. In the past, people used stablecoins because they were more convenient than money. You could transfer them and even earn interest. Now, the authorities are stepping in themselves, offering the same features, but with the added backing of national credit. Just like that, the most valuable advantage stablecoins had has been cut in half. In other words, what used to be grassroots finance growing wildly is now about to be taken over and reorganized by the official forces.
Because once they involve cross-border transactions with the mainland, it gets really, really tricky and complicated. They don't even have a license outside of China. And also, Hang Seng Bank issued a statement saying it won't be able to circulate inside China, so there's no way they can do that.
With the policy now making it clear, the digital yuan is no longer just a payment tool, but has become a digital deposit with yield-generating features. Commercial banks can pay interest on it, and it is protected by deposit insurance. By this November, the cumulative transaction volume of the digital yuan has reached 16.7 trillion yuan, with 3.48 billion transactions. Once the interest-bearing mechanism is implemented, a large amount of what was previously highly liquid capital will be locked within the system. At the same time, this will also weaken the advantage third-party payment platforms have in terms of fund retention, reshaping the landscape of payments and capital flows.
To put it plainly, this move with the digital yuan is a seed that China has quietly planted on the international financial chessboard. In the past, everyone used the US dollar because it was convenient and widely accepted, and you could even earn some interest. Now, China is directly saying, I can offer interest too, and I issue and settle it myself, without having to look at anyone else's face. Once the digital yuan can generate returns, overseas companies will naturally start doing the math. Keeping money in US dollars means being subject to others, so why not switch to a more stable pool? For China, this is not just an upgrade to the wallet, but an attempt to bypass traditional financial barriers. Of course, this path banks need to learn how to manage their money well, the system must be able to withstand high concurrency, and policies need to be carefully calibrated. But if this path succeeds, future cross-border settlements may truly have more options than just the US dollar.
Meta is really going all out this time. In order to play the AI card to the fullest, they directly shelled out billions of dollars. The company behind Ben triggered a butterfly effect, leading Meta to make one of the top 3 largest acquisitions in its history. While others are still training their models, Meta has already started taking action. They've secured the mountain, Today, the Federal Reserve injected funds, injecting $16 billion at once to provide relief. They're not just flooding the market, they fear it's too thirsty. While publicly discussing tightening, they're secretly providing liquidity. They appear calm externally. Inside, everyone is panicking, but on the surface, no one says a word. In reality, the money has already quietly flowed overseas. Companies like Kango and Next Technology Holding are keeping offshore shells while quietly stockpiling assets. They hold thousands of bitcoins. While they talk about strict regulations, their actions are very honest. They just change their identity and get back on board. This is the real Chinese-style participation. Former boxing champion and current internet tough guy Andrew Tate is at it again. This time, he's come out in strong support of influencer Nick Shelley, openly declaring he'll give money to help him expose the truth. Nick didn't hold back either, immediately posting his Bitcoin and Ethereum addresses. If you dare to reveal the inside story, I dare to send money. One exposes, the other sends crypto. It's all about mutual support in a decentralized way. In less than a day, nearly $100 billion was pulled out of the crypto market. Just a moment ago, it was still above $3 trillion. It was bustling with activity, but in the next second, it slipped back to $2.93 trillion. The money didn't disappear, it just moved. Faster than anyone else. The current state of the market is simple. Sentiment has turned cautious, the funds have slipped away first, and everyone is waiting for the next signal.
I'm not in a hurry to prove anything. I just focus on moving forward, making sure I get everything I deserve. As for those who dislike me, I won't avoid them. Instead, I turn all their scheming and malice into fuel, transforming it into the motivation that keeps me going. They will always just be background noise. While I keep moving forward, the protagonist never gets entangled with the noise, only engages with the outcome. While others are stuck in place, I'm already on to the next level. The strong never expect a smooth path. If there are flowers, they pick flowers. If not, they gather mud. Even if the ground is covered in muck, they can still carve out a way forward. Because true confidence never comes from the environment, but from your ability to turn adversity into an advantage at any moment. If you understood, please give us a like. That wraps up the main content of today's program. Our channel focuses on valuable news summaries from the crypto, blockchain, and mining sectors, offering both news updates and in-depth special reports. If you find our channel valuable, feel free to share and follow us. You can also become a member. From Monday to Friday, members receive exclusive wealth codes. Let's get rich together and add another zero to our assets in the bull market.